Have you ever heard this line? भाई, शेयर मार्केट में पैसा डबल करना है. Everyone wants to earn fast. But do you know, according to the NSE 2023 report, 89% of traders in India lost money. 89%. That means out of every 100 traders, only about 10 traders actually made money. Shocking, right? And here's the surprising part. They didn't lose mainly because of bad stocks. They lost because of bad psychology. Yes, the biggest reason people fail in the market is not lack of knowledge, not bad luck, not government policy. It's their emotions. So before you invest even 1 rupee in market, watch this video till the end. By the time you finish, you'll realize the biggest risk in the market is actually it's you. Let's look at the numbers first. According to NSE's 2023 report, the median loss was about 1.1 lakh per person per year. Only 1% of traders made over 1 lakh profit. 1 out of 100, that's it. Now compare that to long-term investing. Over the last 20 years, Sensex CAGR is roughly 13 to 15%, but the average investor earned only 6 to 7%. Why the gap? Because of timing, mistakes, and emotional decisions. People buy high because of greed and sell low because of fear. That's human psychology in action. Why trading feels like gambling? When you book a profit, your brain releases dopamine, the same chemical that fires when you win a game or when you gamble. That's why trading can feel addictive. During crashes, investors check their portfolios 10 times more often. The more you check, the more you panic. The more you panic, the worse decisions you make. Here's another interesting pattern. Studies show men trade about 45% more than women, but on average, women earn higher returns. Why? Because women tend to be more patient and disciplined. And here's a huge missed opportunity. The average SIP duration in India is only 3.5 years, while true compounding starts after 7 years. Many people quit just before compounding kicks in. We all been there. We all know the story. You buy a stock, it falls, then you panic and sell. Next week, it shoots up 10%. Your friend brags, bro, that stock doubled. You buy again. Then, it crashes again. You promise to hold that stock for 3 years, but when the market falls, you sell in 3 days. Every investor has these stories. The market doesn't test your money, it tests your mindset. Let's talk compounding. Albert Einstein called compounding the eighth wonder of the world. If you invest 10,000 per month at 12% CAGR, in 5 years it becomes around 8.5 lakh. In 20 years, it becomes roughly 70 lakh. Same monthly amount, different patience and different results. That's compounding. The smartest investors are not the ones with the highest IQ. They are the most patient. As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. It's 100% true. Shift your mindset. Own businesses, not symbols. When you buy Infosys, don't think of a ticker symbol. Think I own a small part of India's IT growth. That shift from trading symbols to owning businesses changes everything. Investing isn't about guessing the next 10x. It's about picking good businesses and letting time work its magic. Common psychological traps and how to avoid them. First is herd mentality. When everyone's buying, it feels safe. When everyone's selling, it feels dangerous. Markets don't reward crowds. Example, in March 2020, Sensex fell from 42,000 to 26,000. Everyone panicked and sold. Within a year, Sensex was back past 50,000. Those who stayed doubled their money. Second is short-term focus. Retail investors often hold stocks for less than 4 months. Big investors hold for years. Time in the market beats timing the market. Third is confirmation bias. You buy a stock, then only watch videos that confirm your view and ignore red flags. That's defending your ego, not investing. Fourth is overtrading. Trading more doesn't equal to earning more. Position size, discipline, and a plan matter far more. Lack of rules. If you don't define why you're buying, at what price, and for how long, your emotions will define your rules. Now let's talk about practical, actionable rules. Have a plan, entry, target, exit, and holding period. Write it down on a paper. Follow strict stop loss. This will make you more disciplined. Position sizing. Never risk more than a small percentage of your capital on a single trade. SIP and time. Prefer SIP for long term wealth creation. Aim for 7 plus years. Diversify. Don't overdo. 10-15 quality holdings beats 50 random picks. Journaling. Keep a trade. Investment journal. Note why you bought and why you sold. Learn from mistakes. Rebalance annually. Trim winners. Add to losers only if fundamentals remain intact. Control cost and taxes. Brokerage, taxes, and slippage eat returns, minimize them. Key lessons to remember: patience beats prediction. Time turns average stocks into great investments. Discipline beats emotion. Have rules and follow them. Process beats profit. Focus on getting the process right, and profits will follow. Be an investor, not a gambler. Think long term. Own businesses, not tickers. So the next time your portfolio shows red, don't panic. Ask which emotion failed you. The market doesn't destroy wealth, it transfers wealth from the impatient to the patient. If this video changed how you see investing, share it with that one friend who's always chasing quick profits. Because sometimes the best thing you can do in the stock market is slow down. If you want, in the next video, I'll share a simple daily routine and a checklist that investors can follow to stop emotional mistakes and start compounding properly. Hit like, subscribe, and comment patience if you're in.